Good morning. I'm Karl Kaufman, and this is the Morning Market Minute for Friday, April 29th. Today, I want to highlight the extraordinary life of Geraldine Weiss, who passed away earlier this week at the age of 96. Known as the Grande Dame of Dividends, Weiss broke the glass ceiling for women in the male-dominated world of investing. Brokers and advisors she interviewed for said she was better suited for secretarial work, so she went into business for herself. Born Geraldine Schmulevitz in San Francisco, her father changed the family name after experiencing anti-Semitism. She met her husband, a naval officer named Richard Weiss, at a World War II dance. After raising a family at the age of 40, she founded the Investment Quality Trends newsletter in April 1966. She ran it successfully until selling it in 2002. Weiss was completely self-taught and claimed to have read every investing book in the San Diego Public Library. For Investment Quality Trends' first decade, she signed her newsletter as G. Weiss to conceal her identity as a woman. It wasn't until her 1977 appearance on Louis Rukeyser's popular show Wall Street Week that the world knew that G. Weiss was a Geraldine and not a George. Weiss's investment strategy focused on dividends over earnings. In her view, dividends were the best way to measure performance. Earnings can be massaged by crafty accountants, whereas dividends are paid using the company's cash, which is not as easily manipulated. She highlighted the virtues of a small, concentrated portfolio containing 10 to 20 holdings. Her approach focused on dividend yield. First, she would screen stocks based on financial criteria that would ensure a margin of safety. The criteria were outlined in her 1988 book, Dividends Don't Lie. It must be yielding more than its historical average. It must have raised dividends at a rate of at least 10% a year. It must trade for less than double the value of net assets and less than 20 times earnings. Earnings must be at least double dividends. Debt is less than 50% of the total market cap, and it must be considered a financially stable blue-chip company. This would ensure that the company was not at risk of cutting its dividend due to the high yield. Yield and price have an inverse relationship. She would buy a stock when its dividend yield was high, meaning its share price was depressed. As more investors bought the stock, the price would rise and the yield would fall. When the yield was near its historic low, she would sell the stock at a higher price. An avid bridge player, she would play online with Warren Buffett and Bill Gates well into her 80s and 90s. In her words, an enlightened investor, one who can recognize value and quality, will survive in virtually any investment climate. So, to close out the week, let's tip our cap and bid adieu to the Grande Dame of Dividends. I'm Karl Kaufman, and I hope you have a wonderful weekend.